Good morning and welcome this morning to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I am joined today out there in the chat by my good friend Cameron May, 20-plus year veteran in the financial markets. He's there to help answer your questions. You guys are here to ask questions and to learn a little bit about index options along the way, and we're grateful that you're here to do that, whether you're here in the live version or in the recorded version. We're glad you're with us. If you're in the recorded version, leave a comment in the comment section. If you are here in the chat, participate in that conversation. Also do a couple of things. Click on that like button if you happen to like what you're seeing today, and click on the subscribe button down there at the bottom of the page, which you're going to see here in just a minute. That's going to connect you to the Trader Talks webcast channel. We're going to talk index options today. The market's not been moving very much since the last time we talked. And so one of the things that we talked about a couple of weeks ago was a long iron condor on an index expecting a large move. So we're going to take a look at that. We're going to take a look at our 14.7 DTE strategy as well. So let's jump right into it as we get through some of these housekeeping items. Remember that everything we talk about simply for illustrative and educational purposes only. It is not a recommendation or personalized advice. Remember that investing involves risk, including the loss of principal, past performance, no guarantee future results. Now, equity and index options both carry a high level of risk. They're not suitable for all investors. Make sure you're aware of the risks and characteristics of standardized options before considering any option strategy. Now, when we're talking about index options, we're talking about cash-settled options that do not settle to shares of an individual stock. They settle to cash. Also, the majority of the index options that we will talk about, and if there are any exceptions to this, we'll point that out, but the majority of these options are what are referred to as European-style indexes, which means that options cannot be exercised prior to expiration, which removes the risk of early assignment if you are short an option. However, it's important to remember that American-style short options can be assigned at any time up till expiration, regardless of where they are, in the money, at the money, out of the money. It does not matter. So be aware of that fact. Now, we're going to be using the Thinkorswim desktop software platform today, specifically the paper money version of that platform. The paper money version doesn't do certain things. In fact, it does not facilitate the early assignment of short options. But since we're talking about European-style index options, it's not something we have to worry about in this discussion. But there are other factors that the paper money account does not take into account relative to a live account. So just be aware that as you move your trading from paper trading to live, that there might be some differences. Also remember, it's not a guarantee of future success, but it's a great training ground. And we're going to be using technical analysis in this discussion today. We're also going to be using probability analysis. Those are theoretical in nature. Neither one of those is a guarantee of future success. So make sure that you understand that that does not predict the future. And Schwab doesn't recommend these technical analysis as a sole means of investment research. Now, as we jump into our discussion, we're going to talk a little bit about index options. We're going to talk about some strategies, and we're going to look at examples on the platform. And one of those strategies that I talked about a couple of weeks ago is this one, this idea of an iron condor. And an iron condor, either long or short, and we actually went long that iron condor, which means that we bought that iron condor, creates a range-bound area, either a range that we expect the price of the stock to stay within, or the price of the index to stay within, or a range that we expect the price of the index to move outside of. So that being the case, we're going to talk about that particular strategy as well. Let's do this. Let's pop over to the Thinkorswim desktop software platform, and let's take a look at what's going on, and then we'll look at some of those individual strategies here. Taking a look, first of all, at the S&P 500. And by the way, now you should be able to see that subscribe button down at the bottom right-hand corner of the page. Click on that subscribe button. For those of you who have not been here before, by the way, welcome to all of you. But if you click on that subscribe button, it's going to connect you to the Trader Talks webcast channel. It's going to give you the opportunity to set alerts for new content and archives. And it's going to help you to stay connected and makes it easier to find that content. It also makes it easier for other people to find the content, and it's at no cost to you. So take a look at the S&P 500 over the course of the last little while. Maybe 2 weeks or so, we've seen this big, strong rally to the upside and a little bit of sideways movement. The RSI has trended off a little bit, in this particular case. So kind of pulling back and doing it without a lot of upward momentum. And that's consistent with kind of this summer trading perspective, also going into the wait and see mode ahead of the FOMC meeting next week, where there is some question about whether or not interest rates will change. And so that's kind of paralyzing almost, if you think about that perspective, the SPX, right? The market as a whole. Paralyzing in the standpoint that there is some uncertainty. So there's not a lot of decision making. But we're just coming off of a holiday shortened week. We're coming into the first full trading week of this new quarter. And so there's not a lot of activity going on. Traders still perhaps on vacation, or extending those vacations into this week. Not a lot of movement, but we also have, geopolitical risk that's happening and those types of things. If we take a look at the NASDAQ, which has been kind of the leader, although we saw maybe a little bit more of a pullback, a little bit more movement today, but the RSI still falling off a little bit. And then the Russell 2000, which has been perhaps the more captive and kind of range bound of these markets, has made a pretty big move to the upside and now started to maybe kind of run into a little bit of a resistance and a bit more of a bearish divergence on the RSI. So a little bit more of a bearish divergence here on the RSI, right? So as these indexes, which are positive, net positive, meaning they're up a little bit here, you're still seeing a bit of kind of neutral movement at the moment, right? So that being the case, we still have that kind of neutral perspective at this current time. Now, let's take a look at the VIX really quickly here. And I want to pop over here to our VIX grid. And this may be also an indicator of kind of that lack of volatility, if you will. And normally, one of the things that we've seen in previous years, kind of going into this July timeframe, if we look at back where the VIX was last year at this time, it was down in the 12 handle. We're in the 17, 16 handle at the moment on the VIX, which is low, but it's not as low as it normally is. So there's kind of this underlying level of kind of undercurrent of volatility. And if I were to just draw a line across the bottom of this volatility indicator, right, this VIX index, we can kind of see how that VIX low has been elevated, right? The overall, if you look at the 3-year or the 5-year average of the VIX, the 3 to 5 year average of the VIX is right around the 18 handle. And we're lower than that. So we're kind of lower than the overall average, but we're not as low as we normally get in the summertime. So there's still, again, a little bit of that elevated uncertainty, and that comes from certainly tariff issues, certainly comes from the fact that this FOMC meeting portends the possibility of changes in interest rates, but it's not huge risk, right? We're not seeing these spikes. So going into these weeks, just not a lot going on. And that suggests maybe that if volatility is lower, we're not seeing as big a premium for selling those index options that may depend on that volatility for juicy premiums, right? So there we are with what's kind of going on overall in the market. So what I'm going to do is I want to pop back over here to our monitor tab, and I want to take a look at a couple of the positions that we currently have on. And the first one that I want to look at is that Russell 2000 long iron condor, because we were just talking about the Russell. We were talking about the fact that the Russell made that move fairly recently over the course of the last couple of weeks. We put this trade on a few weeks ago. And in this particular case, our expectation was, so if we look at where our short strikes are, right, the 2230, that's the 2230. Let's see if that's our call, 2230 call, and the 2070 put. So our expectation is going outside of that range, below 2230, or excuse me, above 2230 or below 2070. Well, here's where that Russell 2000 index is sitting right now. It's sitting at 2234, outside of this long iron condor. That's what we want to have happen. Let's take a look at this on the Analyze tab here really quickly and kind of see what this is expected to do. So this is a little bit different than a short iron condor. Remember, a short iron condor expects that the price is going to stay within that plateau on this curve, right? So if this were to be a short iron condor, we would expect that price, let me grab my annotation tool here, we would expect that price would stay within this range right here. But given the fact that this is a long iron condor, we bought this trade as a whole to begin with, then what this suggests is that we want to see price stay either below that short strike or above that short strike to either see a small loss or a small gain or maximum theoretical gain. So here's the point at which we would see maximum theoretical gain on either side. So if price were to be below our long strike on the put side or above our long strike on the call side, that's where we would see maximum theoretical gain. Well, here's where price is right now. This price slice right here is where price is right now. We are right there at that point where we're seeing maximum theoretical gain. Now, here's the difference. Let me ask you this question. And I know Cameron, in one of his webcasts recently, and I'm not sure exactly which one it was, but I noticed the title, and I thought this was really cool. Cameron asked the question. He said, see if you can answer this top 10 quiz on options from Coach Cam. And one of those questions was, if you're short an option, do you want time decay working in your favor, or do you want time decay working against you? If you're short an option, what is time decay doing? Is it working for you, or is it working against you? So I'm just going to ask you somewhat rhetorically, if you want to answer in the chat, you can do that. What do we want time decay to do if we are short an option? I'm just going to throw that question out there. Anybody? Anybody? Bueller? Question? Hello? Okay. If we are short an option, we want time decay working in our favor. And when we're short an option, we want that time decay to work to decrease the value of our option, right? Which, if we're short an iron condor, that's exactly what we want to have happen. But we're not short an iron condor. We are long an iron condor, correct? So if we're long an iron condor, time decay is working against us in this particular case. So if I open up these price slices and I take a look at where the price of the stock currently is, or the index currently is, notice what this theta number indicates. That theta number, in this case, indicates every day that we wait, every day that goes by, that time decay is eating up $3.68 from our premium in this long iron condor. Now, volatility is working in our favor. So if volatility rises, that's helping us out. But guess what volatility has been doing? Staying just about the same. So we haven't gotten much benefit there. But we're losing if we wait on this trade. Okay? We are losing if we wait on this trade. So let's go back to the market, or to the monitor tab. Let me clear those annotations really quickly. And we'll come back to our monitor tab. And this is a trade that we paid $5.45 for. And it is now trading at $6.60. Okay? $5.45. It's currently trading at $6.45. So notice that this is a $10 wide. Here's what I just want to do with this trade here really quickly. This is a $10 wide spread, and we paid for it $5.45, which means that our maximum theoretical gain in this trade on either side, one side or the other, is $4.55, right? That's the max that we could gain in this trade if it went to maximum theoretical gain at expiration. But in order to get to that point, it would have to be at expiration. So we know that we're not going to get maximum theoretical gain. We knew that when we put the trade on, but we were expecting a move one side or the other. And it doesn't make it matter if it's a big, huge move one way or the other, just as long as it's outside the range of our long iron condor. So what we could look at then in this particular case is the fact that if we were to close this trade down, we're getting a buck of that $4 of maximum theoretical value. And every day that we wait, we've got 22 days to go until expiration on these options. If we were to wait for those 22 days and the index did not move more than it has, right? And we're decaying away that premium, we may run into the situation where we might lose what premium we've had because we give the stock the index the opportunity to move back within the iron condor. So that being said, we could leave this trade on for another week and see if we can capture a little bit more gain in this trade as that long option continues, those long options continue to appreciate and the short options continue to decay away. But that's what's happening right now is these short options are decaying away, which is kind of working against us, kind of working for us because the long options are decaying away as well. So we still have to keep in mind that time decay. So what I'm going to look at doing here in this particular case is I'm going to right click on this position and I'm going to say create a closing order. So here's what I want to see. I'm going to create a closing order to close down this long iron condor if we can get $7 out of that spread, which if you were then to do the math here, $7 minus the $5.45 that we paid for the spread, we'd be picking up about $1.55, right? We'd be picking up $1.55. Okay. So in this particular case, you're right. So the advantage of doing a long iron condor is in a circumstance when implied volatility is low and potentially rising. We didn't get the rise in implied volatility that we expected, but we got the move outside of the range. So low and rising implied volatility with an expectation of large movement may benefit a long iron condor as opposed to a short iron condor. Because if we have a short iron condor and implied volatility rises, that's working against us. And if we have a short iron condor and and the price of the index doesn't move, that's working for us. But if the price of the index does make a big move, that's working against us in a short iron condor. So that's the reason why in this particular case, we chose a long iron condor in this particular case. So we're going to put this trade in. We're going to look to take this trade off if it gets to $7 and we can sell this long iron condor for $7 or better. And I'm going to make that good till canceled. And we might get some volatility that comes in. We might get a little bit of a bump here in some intraday volatility that might push us to that point. We're going to read through this order and we're going to put that back in our index options group. Make sure that we're aware of that. We understand that this is the closing order. We're closing down this position. Click on send. We'll put that order out there to wait. Okay. To put that out there to wait to close that trade down as necessary. Remember, 22 days to go until expiration on that spread. All right, now let's come back to our monitor tab now that we've dealt with that one. Here's one that we have had on for a little while. This is our Swiss franc short vertical. And so if we were to take this and we were to look at closing order, I'm sorry, this was a long vertical spread, right? We could sell this back right now for $5.60. So let's just do the calculation. Let's see what we paid for it to begin with, right? So we bought the long call, the 120 call, for $3.55. I'm going to grab my calculator here. So we bought that for $3.55. And look at that. We got $7.40. That's one of the potential advantages of putting in a limit order to close the trade down like that is if you get a big volume spike or you get a big bump and the bid-ask moves, you could get out on a pretty advantageous fill. Doesn't always happen, but that may be a possibility. So we got out of that long iron condor at a little bit better position than we thought we would, about a $2 gain in that trade as opposed to $1.55, which is great. Not a problem there in getting out of that trade for more. Okay, but we paid in our Swiss franc trade, we paid $3.55 for our 120 call, the long option, and then we sold the 128 call against that for 57 cents. So we've got to take $3.55 minus 57 cents, gives us a total cost on that trade of $2.98. Now, we did that a leg at a time, which is why it doesn't show up as a vertical spread here. But it was a long vertical spread that we paid $2.98 for, roughly. Okay. Now, if we were to close this trade down, again, I'm going to come down here and I'm going to say create closing order. I could sell this back for $5.60. So let's do the math. $2.98 is what we paid for it. $5.60 is about what we could sell it for, minus $2.98. Gain on the trade about $2.62, which was just about what we expected to make on the trade. It's a $8 wide spread. So we're about 60% thereabouts of our maximum theoretical gain in this trade. So let's go ahead and put this order on. We were looking at taking advantage of a rising Swiss franc. Given global insecurity, the Swiss franc tends to be a safe haven. Doesn't always work out that way, but it tends to be a safe haven. And I'm going to work this order a little bit. I'm going to see if we can get this for $5.60 instead of $5.58. And I'm going to make that a good till canceled order, see if we can get that $5.60 for it. Click on confirm and send, read through the order, make sure that we're aware of that. That's a closing order. Make sure that we're aware of any alerts that might be here and click on send, and we're going to fire that order off. And we got it for $5.62. It always pays. Now, to be fair, this is paper money. This is one of those differences. Sometimes paper money gives you some advantageous fills. Not always, but sometimes it can, especially if there are wider bid-ask spreads. You'll oftentimes get filled at the midpoint, where in a live trading account, you might not get filled at that midpoint, and it might not be so advantageous for you to get out at that particular point. So we've closed that one down. That was a trade that worked in our favor. That Russell 2000 long iron condor trade worked in our favor as well in this particular case. Now let's go to our 14-7 strategy here really quickly. I sold this one last week, even though I wasn't teaching the class. I sold this vertical spread, the 60-80, 60-60 short put spread, expecting that the SPX was going to continue to rise. Sold it for $1.90. Remember, implied volatility was relatively low. It's currently trading for $1.20. And our rule in this particular case, in this consideration, in this particular strategy, is we put the trade on at 14 days and we take it off at 7 days, come what may, right? And that's kind of the rule in this particular case. This strategy, the way that we're implementing it, you can do what you want. You could hold this to expiration, look for more gain in the trade, but we're going to take this off come what may at 7 days to go until expiration. And this is a winning trade at this point, but it's not a big winner. It's a small winner, right? We sold it originally for $1.90. If we could buy it back for $1.20, we made a little bit in the trade, not much, but it's still a win in this particular case, right? And this is not a home run hitting type of strategy. This is a singles and maybe sometimes doubles type of strategy. And sometimes we strike out. And we've struck out a few times as well, where the trade has gone completely against us and we've taken our max theoretical loss in the trade. So that's happened a few times, not on a necessarily regular basis. Okay, so let's do this. We're going to take this trade off first. So I'm just going to come up here and I'm going to right click and we're going to create a closing order. We're going to buy that back and we're going to buy that back for $1.20. Let's go ahead and click on confirm and send, and we'll close that down. We'll make sure that we read the order, make sure it's a closing order, read through to make sure that there are no alerts that we need to pay attention to, and click on send, and we fire that order off. Okay. All right. Now, as we do the next part of this strategy, we're going to go back to the charts and I'm going to bring up our index grid, right? Here it is, our index options grid on the SPX. So we've got this probability of expiring cone. Left-hand side is a 1-year daily chart. Right-hand side is a 3-month, 1-day chart. The link to this grid is down in the description of this webcast. And so you can put this up, you can pull this up and put it into your own Thinkorswim platform. But here's what we do. And you can see what's been going on with implied volatility. Implied volatility has been continuing to move to the downside. Sorry, Jerry. Yes, I get excited about this stuff. I apologize if I'm speaking too fast. I will try to consciously slow down, but I get excited about this stuff. Do you guys do that? I mean, do you guys get excited about this? Trading in general for sure, but sometimes trading index options and trading around these ideas and what's going on. I know Cameron gets excited about this stuff. I do. So let's do this. What we're going to do is we're going to go to the trade tab and we're going to look at our 14 days to go until expiration. That's the 23rd of July expiration. Okay. So we know that that's the timing. And we're going to go to back to the chart. Now, here's the thing. Yeah, there you go. YouTube gear, playback speed 0.75. And then I'm normal, David, right? Okay. The index is still above the 200 period moving average, so we're still selling put spreads. Okay? So we're still selling put spreads here at this particular point. But what I'm going to do is I'm going to come over here and we're going to make a time hack right here using our time level. We're going to make a time hack at July 23rd. There's July 23rd. So we're going to make that time hack right there. The next thing that we're going to do is we're going to go right here. We're going to use the trend line tool and we're going to go to the intersection of our time hack and our probability of expiring cone. And that's right there. We'll just draw that line right there. There's our intersection of our probability of expiring cone, remember, which is the 1 standard deviation curve at option expiration dates, right? That's 1 standard deviation. That's what that curve shows, is 1 standard deviation. Let me pop this open so that we can see this. I'm going to maximize this. Maximize that cell. Let's maximize that cell so that we can see it. All right. So this is 1 standard deviation. And where is that level? It's at the 60-60. I'm going to call that the 60-60 level. Okay. So the 60-60 level, if we go back to our trade tab and we go to our July 23rd expiration, we've got 100 strikes, which is 50 up and 50 down. And we're going to go to the 60-60 strike. You notice that that's about the 14-cent delta, right? That's about the 14-cent delta. Notice what's happening here, because if we go back to that chart really quickly, look at the range where these spreads have been sold, right? It's narrowing. What's been going on with implied volatility? It's been falling. As implied volatility goes down, that 1 standard deviation range shrinks. It gets smaller. It gets closer to where the price of the index is. So that is one of the reasons why we're ending up selling here. But it's still the 14-cent delta, which implies that there is a 14% probability that that option is going to be in the money at expiration. Which means that it's got, 86% probability of being out of the money at expiration, theoretically. Remember, probability and probability analysis is not guaranteed. It is theoretical. And so we're going to make this a 20-wide vertical spread. We're going to sell the 60-60, and we're going to buy the 60-40. And we're going to do that for $1.90, exactly what we got last week. Okay, so that's fine. The implied volatility is fairly low. We know that that's the case. So we're going to sell that for $1.90, and we're going to expect that we're going to take this trade off next Wednesday for whatever we can capture out of that premium, whatever we can capture out of that $1.90. So I'm going to go ahead and I'm going to click on confirm and send. We're going to read through this order. And again, the risk. Okay, so here's the risk perspective, right? Okay. Is, we're bringing in a $1.85 or $1.90, right? And our max theoretical loss is significantly higher than that, right? Because this is a $20 wide spread. So we accept that fact because it's a high probability trade. Remember what I said about probability a couple of weeks ago? I said that we as traders typically tend to underweight the likelihood of a high probability scenario happening, and we typically tend to overweight mentally the probability of a low probability outcome happening. So we tend to focus on the negatives as opposed to on the possibilities of a high probability scenario. That's just human nature, right? We tend to be somewhat skeptical. So this is essentially around trying to reverse that idea. This is a high probability trade. There's a high likelihood that this is going to be successful at some point. Not a guarantee by any means, but from a trading psychology standpoint, we're kind of focusing on the high probability aspect of this trade. The price of the index is well above the 200 period moving average. We're at the 14-cent delta, which is a high probability level. And we've got, a low implied volatility, which suggests that there's not the potential for big movement. So that's okay. That's kind of what gets us to this point, right? Yeah, and you're right. The probability is because of the risk and reward, from that standpoint. We're not looking at making a big score here. So we're going to put this in our index options weekly group, and we're going to go ahead and we're going to click on send, and we're going to fire that order off. And we got filled for $1.90 in this particular case. Now, Priya asks a great question and good attention to detail here. So Priya noticed that my probability of expiring cone shows 30 days and 68% probability. So I'm going to go to my flask icon right up here at the top. I'm going to go to the gear icon, and you notice that it says a 30-day period and a probability range of 68%. Okay. Now, one of the reasons why I changed this is really simply not changing the calculation of the probability curve, right? All it's doing, all this periodicity here is changing this from 30 because by default it is at 100. In this particular case, is I'm showing out into the future that length of time. It doesn't change the shape of the cone, right? It does not change the shape of the cone. So by default, when you were to put this probability of expiring cone on here, it would do this. It would go out 100 bars out into the future. You click on apply and OK, and it shrinks this chart over to the left-hand side, and it leaves that big probability of expiring cone way out into the future, right? Which is fine, but I wanted to condense this display a little bit. So I went to the flask icon here, and I went to that gear icon, and I made that 30 days just so that I could see over the horizon just a little bit more. Now, we could make that, and Priya's suggestion is making that 14 days, which would be fine. It doesn't change the shape of the curve. It just changes how much is displayed, right, out into the future. So it just makes that chart even a little bit more condensed. Doesn't change where it is. You can see that the shape of the curve didn't change. The location of that intersection did not change. It's just a display function. So I'm going to leave that at 30 just so that we have a little bit of additional room out into the future so that we can see where that is. There's our 30 days to go until expiration, or 30 days out into the future on that probability of expiring cone. Great question and great attention to detail. I like that when you guys are looking at those things and kind of seeing what is going on. All right, now here's the other thing to think about. Let's go back to our monitor tab for just a second. And we've had a couple of different spreads on here before, right? We took off these two trades here. We took off the Russell. We took off the Swiss franc. But here's something that's kind of sticking with me, right? We go back to this VIX grid, and I take a look at this VIX grid, and I say, look, even though we're coming into the summertime, right? And we're coming into this situation where volatility is low as it typically is. It's not as low as it typically is. But this is a different summer than last summer. I mean, last summer might have been hot girl summer or hot option summer. This summer is something totally different, right? We've got new influences in the market that we haven't necessarily had before. This threat of tariff implications, the possibility of changing interest rates. So we could see a bounce in implied volatility. We could see the VIX start to rally a little bit and rise from this level. So my thought was, if we can use an index option to potentially do this, I also want to look at this tool right here, which is the VIX versus the VVIX. So the VVIX is the volatility of VIX, the volatility of volatility, right? And typically when the VVIX is rising and the VIX is falling, that tends to impart an upward drag on volatility, because what this suggests, what this VVIX being higher than the VIX suggests, is that option buyers who use the VIX, namely institutional traders who use the VIX or SPX options as a means to hedge long stock portfolios, are now willing to pay more. They're starting to buy those VIX options, and they're willing to pay more for those VIX options because they're cheap. So this is a circumstance where that VVIX has been low and now starting to rise, and the VIX is kind of trailing behind it, where institutions recognized, put it in the metaphor. Here's the metaphor. Buy umbrellas when it's not raining, right? Because that's when they're cheaper. When it's raining, umbrellas are more expensive. So what's going on right now is those option buyers, institutions, are saying, hey, it hasn't been raining, but it could rain. Umbrellas are cheap, so let's start buying some umbrellas. And that may have a tendency to drag implied volatility up. And Carol, you're absolutely right. VIX will typically follow the VIX. So that says, all right, cool. Implied volatility is cheap. Let's buy some protective options. As an institutional trader, that's might be my thought process. So what we're going to do is we're going to look at taking advantage of that possibility, and we're going to create a trade on the VIX using an index option. So what we're going to do is we're going to go to the chart again. Let's go to our index grid. Let's come back to our index grid, and let's put in here VIX, because we know that we can't trade the VIX, but what we can do is we can trade options on the VIX, right? So here's our option chain for the VIX. Now, the one thing to keep in mind with VIX options is that VIX options are European style. However, they are AM settled, which means that there is overnight risk if we take it into expiration. So we're not going to take this into expiration. We're going to look at taking this trade-off prior to expiration. So in the coming weeks, we've got a couple of things. One, we've got the start of earnings season. Two, we've got the FOMC meeting coming up. And we've got the tariff deadline on August 5th. So you know what I'm going to do? I'm actually going to give us a little bit of duration here. I'm going to look out at the 20 August expiration. Now, we could do a couple of things. We could buy a long VIX option, which in and of itself is kind of weird, because if the VIX rises, that's augmenting the value of that option anyway, because implied volatility is going up. Kind of a little meta reference there. Not meta the stock, but meta, kind of a large scale meta reference to implied volatility. If we were to go on to that 20 August expiration, give ourselves a little bit of duration, and if we were to buy a call option, you can see how these call options are a little bit skewed in terms of price. We could buy a call option on the VIX, say for instance the 15 strike call option, or even the 16 strike call option, and we could buy that long call for $4.60. And if implied volatility went up, that's going to benefit that option, right? But that's going to be relatively expensive nonetheless. I mean, not hugely so, but we can make that a little bit better. What if we were to create a long call vertical on the VIX that may benefit from a rise in implied volatility, which is what we want to have anyway, because we're expecting the price to move higher. So generally, when we put on a long call vertical, one of the things that we might think about doing is buying where the underlying is now and selling where we expect it to go. So look, if we get a rise in the VIX just up to that kind of one standard deviation, right, that probability of expiring cone, that puts the VIX up at about the 20 handle. Not at all outside the realm of possibility. So we're going to go back to the trade tab here, and we're going to buy the 16 strike, because that's where the VIX is currently. It's about 1623. I'm not going to buy the 1650 because it's just out of the money in this case. Actually, maybe we could. Let's do that. That's going to be a little bit less extrinsic value. Let's go to the 16 half. We'll give it a little bit of speculative movement. So buy where the stock is, or buy where the underlying is. So we'll buy the 16 half. I don't often like those round or kind of odd numbers, but let's do this. Let's buy the 16 half and we'll sell the 19 half. We'll cheat it a little bit to the downside and not look for it to get all the way to the 20 handle. So we're going to buy the 16 half, and we're going to sell the 19 half, and we're going to do that for $1.35, which is a lot less than the premium for just buying an in-the-money VIX option. And if we click on confirm and send here, then we see that we've got a little bit more profit potential in this trade if it goes all the way to that short strike. Then we stand to lose in the trade. What we stand to lose in the trade is what we're paying for it. So if I do this and I right click and we send this to the Analyze tab for this VIX vertical spread, here's our long call vertical. Let's take our expiration out to our August. What are we? August 20th. So we're going to go out to August 20th. We're going to go right there. There's our expiration range. And we're going to set slices to break even at expiration. And if we squish this back together, there's our break-even point, $17.85. So we're just about, there's $17.85 on the VIX, and we're almost there now. But look, theta is not really working against us. Volatility is going to benefit us, and we've got a little bit of delta, some directionality to this particular trade. So what I'm going to do is I'm going to pop that back up, and we're going to go ahead and click on confirm and send. We're going to read through this order. We're going to put this in our index options group, make sure that we're aware of any transaction costs and any alerts that might be there. Click on send, and there we go. We bought it for $1.35. Now, the expiration, so Frankie, yes, it settles based on the AM print, the morning print, but it stops trading the night before, which is why we're not going to take it through till expiration, Frankie. That's one of the things, and thank you for catching that. So that is the reason why we want to make sure that we're going to close this down prior to expiration. All right. Wow. We've done some great stuff here along the way. If you want to learn more about index options, come on over here to the Trader Talks webcast page. Type in the word index, and you're going to find a whole slew of webcasts talking about index options. By the way, if you're brand new to this discussion, join me for this one right here, Intro to Index Options. It's a great way to get started trading index options. A lot of stuff going on here. Guys, thank you so much for joining me. Thanks to Cameron for helping out and answering questions, and you guys being very active in the chat today. Remember to follow us on X at Ben Watson CS, at Cameron May CS. Remember to click on the subscribe button down here on this page to connect to the Trader Talks webcast channel. I'm going to see some of you in Santa Clara this weekend, and at our technical analysis and option strategies live workshop. And then I will see the rest of you back here next Wednesday for more index options. Take care, everybody. We'll see you soon. Bye-bye.